You think you make logical decisions with your money. The data suggests otherwise. Let's run the numbers. Mathematically, winning $100 and losing $100 are equivalent outcomes. They're opposites of the same magnitude. But psychologically, they're not equivalent. The pain of losing $100 is felt much more strongly than the pleasure of gaining $100. This is loss aversion. It's one of the core findings of prospect theory. Kahneman and Tversky proposed prospect theory in 1979 as an alternative to expected utility theory. Expected utility theory assumed rational agents evaluate risks symmetrically. Prospect theory said, no, they don't. The problem: how do we actually evaluate risk in real choices? Expected utility theory predicted people choose based on expected value, simple multiplication, probability Klang's outcome. But real people don't think that way. They think in terms of gains and losses relative to a reference point. The reference point is usually current wealth or a recent price level. Everything is evaluated relative to that point. This reference point shift is automatic and involuntary. Once you own a stock, the purchase price becomes your reference point. Selling at a loss feels like you're giving up something. The pain is acute. Research shows loss aversion has a coefficient around 2. Losing $1 feels like losing roughly twice as much utility as gaining $1. This isn't universal. The coefficient varies with context, wealth, and individual differences, but the asymmetry is consistent. The second key mechanism, diminishing sensitivity. Your emotional response to money diminishes as amounts increase. Gaining $100 feels wonderful. Gaining $100 after already gaining $1,000 feels nice but less wonderful. The marginal utility of money decreases. This is why millionaires are relatively unmoved by small sums. Together, loss aversion and diminishing sensitivity create the characteristic S-shaped value function of prospect theory. This function has profound implications for financial decision-making. When faced with a risky choice involving potential gains, people become risk-averse. They prefer a sure smaller gain to a risky larger gain. This is called the certainty effect. Certainty has outsized psychological value. But with potential losses, people flip. They become risk-seeking. They prefer a risky larger loss to a certain smaller loss. When facing a sure $100 loss versus a 50% chance of $200 loss, people choose the gamble. They prefer the risk. This is the reflection effect. Risk preferences reverse when the frame shifts from gains to losses. Tversky and Kahneman in 1992 refined the original prospect theory into cumulative prospect theory, adding more precision. The equity premium puzzle illustrates prospect theory in practice. Why is the gap between stock and bond returns so large? Expected utility theory couldn't fully explain it. The expected return on stocks should equal bonds more closely. Benartzi and Thaler, 1995, proposed an answer: loss-averse investors. Evaluated annually, even a long-term stock strategy shows negative years. Loss-averse investors hate this. They demand a premium to accept annual volatility. That premium shows up as the equity premium gap. The implication: investors systematically underweight stock investments because loss aversion is so powerful. Now here's the boundary. Prospect theory describes what people do, not what they should do. The question: knowing about loss aversion and the reflection effect, how should investors respond? Answer: you can't fight loss aversion by willpower. It's built into your nervous system. Instead, engineer around it. First engineering move: stop checking your portfolio frequently. Loss aversion triggers most acutely when losses are salient. If you don't see the loss, you don't feel the loss emotion. Second move: automate your long-term investments. Set it and forget it. Automation prevents the reflection effect from reversing your strategy when temporary losses appear. Third move: use a long time horizon. Prospect theory applies to annual or quarterly evaluations most acutely. Over 20+ years, stock market returns have never been negative. Prospect theory's loss aversion becomes irrelevant if you can't actually lose. So if loss aversion only triggers when losses feel real, make losses impossible by using a true long-time horizon. Fourth move: frame gains and losses as annual or long-term outcomes, not daily or weekly fluctuations. This is choice architecture working with loss aversion, not against it. The resolution: prospect theory predicts loss aversion will derail your portfolio. The response is not willpower but design. Application: build a portfolio structure where rebalancing is automatic, not discretionary. Your 60-40 portfolio rebalances quarterly to stay at 60-40. When stocks drop, automatic rebalancing forces you to buy low. You don't feel the pain because the decision isn't yours. The system made it. This is how you overcome prospect theory's prediction, not by denying loss aversion, but by making emotion irrelevant. The implication: prospect theory shows that rational decision-making requires structure. Left to emotions, we'll underinvest in stocks and overweight bonds. Benartzi and Thaler's work suggests loss-averse investors would rationally choose a 60-40 stock-bond mix if they could commit in advance and then stop checking their account. But check the account weekly, that 60-40 rationally becomes 20-80 as loss aversion takes over quarterly. The solution: once you commit, don't check. Salience matters. Don't make loss aversion worse by constantly observing temporary losses. Step 1. Decide on a reasonable long-term allocation, 60-40, 70-30, or whatever matches your risk tolerance and time horizon. Step 2. Automate rebalancing. Quarterly or annually, the system rebalances back to that target. No discretion. Step 3. Minimize monitoring. Check annually or quarterly for rebalancing. That's it. Don't watch daily returns. Step 4. Frame your thinking about returns in long-term terms, not daily or weekly terms. Ask, will this help my 20-year outcome? Not, will this help my portfolio today? Most daily portfolio moves won't matter. Most won't even be remembered in 5 years, yet they trigger loss aversion today. This is the prospect theory lesson. Your emotions are useful guides for immediate decisions, but terrible guides for long-term investing. The implication: remove emotions from long-term investing by removing yourself from decision-making. Let structure and automation do the work. Don't fight your brain. Engineer your environment. See you next time.